Imagine this: a digital dollar that moves across borders in seconds, settles payments without banks taking a cut, and powers everything from your morning coffee to global trade deals, all while staying rock steady at $1. That's the promise of stablecoins, and in 2026, they're exploding beyond crypto hype into the backbone of the internet economy. Welcome to the Generational Wealth community, your pathway from knowledge to legacy. We don't chase hype, we decode the market. Today, we're diving deep into stablecoins as the internet's dollar. We'll break down their massive growth beyond mere speculation, explore origination models driving innovation, spotlight real-world payments, integrations, and unpack the regulatory tailwinds propelling them forward. By the end, you'll see why stablecoins aren't just surviving. They're thriving as the new standard for digital money. Let's get into it. First off, the growth story is staggering. Stablecoins have ballooned from under $30 billion in circulation back in 2020 to over $310 billion today. With projections hitting $1 trillion by late 2026, that's not speculative fluff, it's real utility. Transaction volumes tell the tale. Global stablecoin payments hit $33 trillion in 2025, surpassing PayPal by 20 times and closing in on Visa's scale. But here's the shift. Most of this isn't trading bots inflating numbers. Adjusted for real activity, we're seeing $9 trillion in genuine transfers, with business-to-business payments leading the charge at $226 billion annually, accounting for 60% of the volume. Think remittances zipping across borders at fractions of traditional costs, or payroll settling instantly without forex headaches. In Africa, nations like Nigeria and South Africa are driving demand, with over half of users increasing holdings last year for everyday stability amid volatile local currencies. Stablecoins are becoming the go-to for emerging markets, where they're not just an asset, they're a lifeline. Now, let's talk origination models. These are the blueprints for how stablecoins are created and backed, ensuring that one token always equals $1. The dominant model is fiat-backed, where issuers hold real-world reserves like cash, bank deposits, and short-term U.S. treasuries. Take USDT from Tether and USDC from Circle, they command 90% of the market, with USDT alone averaging $703 billion in monthly volume last year. These are audited monthly for transparency, pegged one-to-one to the dollar. Then there's crypto-backed models like DAI for MakerDAO, over-collateralized with other digital assets for decentralized stability. Commodity-backed ones, such as POX Gold, tie value to physical gold, 1 token per ounce. Algorithmic stablecoins adjust supply dynamically, though they've had bumps in the past. In 2026, we're seeing evolution. Fidelity just launched its Fidelity Digital Dollar, or FIDD, in early February. Backed by institutional-grade security and available for retail and institutional investors, under new regs, origination is shifting to regulated entities, banks, trusts, and licensed issuers, focusing on safety over speed. This maturation means stablecoins are originating not just as trading tools, but as yield-generating assets for treasuries. With debates on interest payments heating up, no more Wild West. It's structured, scalable origination, powering on-chain finance. Payments integration is where stablecoins truly shine as the internet's dollar. Forget clunky wires or high-fee cards. Stablecoins enable seamless, 24/7 flows. Visa's leading the pack, expanding USDC settlements into its core operations for issuers, hitting a $3.5 billion annual run rate by late 2025. Stripe lets merchants accept USDC across networks like Ethereum and Solana, settling in fiat to avoid volatility. PayPal's PYUSD is embedding into wallets for crypto payments that convert to merchant fiat, slashing cross-border costs. Stablecoin-linked cards are booming too. Spending jumped to $4.5 billion in 2025, up 673% year-over-year. Providers like Kobo offer enterprise-grade payouts across 80 blockchains, while Bridge and BVNK focus on embedded APIs for fintechs. In B2B, stablecoins handle $226 billion in flows, streamlining supply chains and liquidity. For consumers, it's hybrid magic. Send fiat, Cross borders via stablecoin. Receive local currency, all instant and cheap. Funds and MoneyGram are live examples, powering remittances to wallets in remote islands or urban hubs. This isn't pilot stuff. It's operational, turning stablecoins into programmable money for AI agents, global commerce, and everyday spends. Fueling all this are massive regulatory tailwinds. The U.S. Genius Act, signed in July 2025, created the first federal framework for payment stablecoins, defining them as non-securities, non-deposits, with strict reserves in treasuries and cash. Issuers only authorize bank subs or OCC licensed entities, with full implementation by mid-2026. February updates are game changers. The SEC slashed capital haircuts for broker-dealers holding stablecoins from 100% to 2%, signaling they're as safe as treasuries. NCUA proposed rules for credit unions to issue them, closing comments in April. CFTC updated definitions to include national trusts. White House meetings push for yield compromises by March, potentially unlocking trillions in adoption. Globally, EU's MiCA is live. UK's regime demands FCA authorization, and Asia's frameworks in Singapore and Hong Kong emphasize reserves and disclosure. This clarity isn't stifling, it's accelerating. Institutions like BlackRock and JP Morgan see stablecoins as structural demand for U.S. debt, reinforcing the dollar's dominance while enabling tokenized assets and DeFi. Stablecoins are redefining money. Stable, borderless, efficient. They're the internet's dollar because they work where fiat falters. Fast, cheap, and programmable. As we head into this bull cycle, watch for that $1 trillion milestone. It's closer than you think. Subscribe for daily recaps. Drop a comment on your biggest takeaway, and turn on notifications. We do a crypto news video every morning and a deep dive every afternoon. Let us know in the comments any subjects you'd like us to cover. Quick disclaimer, I'm not a licensed financial advisor. This is for educational purposes only and not financial or investment advice. Crypto is volatile. Never invest more than you can afford to lose. Do your own research.